So the tone across Silicon Valley has shifted. For the past 3 years, much of the industry has been selling a story. AI as inevitability, AI as limitless growth, and AI has margins that defy gravity. January 29th, 2026 marks a very different phase. The promotional cycle is over. What follows is operational reality. And operational reality is expensive. What we saw this week was a coordinated signal from the largest players, Meta, Microsoft, Tesla. 3 different companies operating in different markets facing the same very question. Is this infrastructure race a business or simply an extended experiment funded by capital? The pressure point is no longer product capability, it is financial sustainability. Let's start with Meta. Meta is at the center of this shift. On the surface, the numbers are very strong. Revenue reached $59.89 billion ahead of expectations, so well done. Earnings per share came in at $8.88. The advertising is still working pretty much, but the underlying story is a little more complicated. Ad impressions are up 18%, but the pricing is up only 6%, and that gap is significant. It suggests growth is being driven by volume rather than pricing power. So at the same time, costs are accelerating. Meta is increasing capital expenditure guidance for the year. Large sums are being allocated to AI infrastructure, to virtual reality, and what Zuckerberg describes as personal superintelligence. These are, of course, long-term bets. They are also very high burn investments. The message from the leadership is not defensive. Spending will continue, and the market response has been measured but positive. Meta's share price rose after the announcement, not because costs are under control, but because advertising revenue remains very strong to absorb the pressure. In effect, the core business is financing the experiment. So what does Zuckerberg do? He does this. Zuckerberg has chosen to front load the investment cycle. He has offered near-term revenue guidance above consensus, and in doing so, he's bought time, making it a declaration of intent. Meta is no longer optimizing for incremental efficiency, but instead building long-term capacity and capability. And this choice places it directly inside the new phase of the AI economy, one where growth is assumed, but profitability must now be proven. And now, of course, we come to Microsoft. The numbers were clean. Revenue, $81.27 billion. Azure and cloud growth, 38%, which is a massive number. Operative income is over $38 billion. On paper, this is definitely a victory, but in the larger context of things, it was a stumble. The stock moves lower. Why? Because of the margins. The cloud gross margins slipped from 70% down to 67%. That is the result of expensive chips eating into your profit. Investors looked at Satya Nadella and asked, when does this spending stop? The capital expenditure was, of course, higher than expected. The backlog is huge. OpenAI commitments are stacking up, but the market is getting impatient. Satya says we are in the early innings of AI diffusion, but the market says, please hurry up. Microsoft may be, of course, the load-bearing structure of the AI revolution, but let's not forget, even load-bearing structures feel the strain, and the market is starting to notice. Now, of course, Tesla, the wild card. Elon Musk didn't sell cars last night. So what do you think he did? He sold a dream. Yes. The numbers were all over the place. Revenue was a miss at $24.9 billion. But he beat on EPS at 50 cents. And of course, here is the magic trick which Musk is selling. Well, it could be an illusion as well. Because when it comes to the car business, that's boring. But hardware priced like software, yes, that's where the excitement is. Musk got on that call and didn't actually talk about panel gaps. He spoke about systems. 6 new production lines, the Cyber Cab rollout, Megapack 3, and of course the Golden Goose, which is Optimus. He confirmed volume production lines for the robots and he shifted the focus. He said to the market, don't value me as a car maker, value me as an autonomy company. end quote. And of course, the market lapped it up. Shares saw an uptick. Why? Because in a not so earth-shattering quarter, if one can bring clarity on the future ahead, that is definitely worth more than a pulse on the present. Then, of course, the conversation shifted from slow EV demand to robotics dominance, which of course makes it more like a high wire act. If he slips on execution, mind you, it's a long way down. But for now, of course, the wire is holding. And what is also going to hold your attention is the front page take. So where do we stand? The risks are real. One is margin pressure. If you spend billions on NVIDIA chips, but your margins shrink, the market will punish you. Just ask Microsoft. Then we come to number two, which is execution. Tesla is priced like a call option. If the robots don't show up, the option expires. Worthless. Number three, the referees, which is regulation is circling Meta and Microsoft. The government wants a piece of the action. The bottom line for 2026, the speculation phase is over. The AI is cool phase is long gone. We are, of course, bang smack in the middle of the infrastructure war. Winners aren't the ones with the best chatbots. The winners, ladies and gentlemen, are chosen on the basis of their ability to burn billions of dollars, yes, and build data centers. And somehow, very miraculously, turn that very ash into repeatable cash flow. Meta, of course, is using ads to pay the bill. Microsoft is asking you to trust the cloud. Tesla is asking you to trust the robots. You know what? Look out for the margins, the guidance, and please, please ignore the hype. Because the bill is definitely due, and we need to see who can actually pay for it. This, ladies and gentlemen, is always Front Page by AIM Network. You know what to do. Like, share, subscribe, and always remember, think AI, think AIM.